Welcome everybody to the Chinchilla Pickin' Podcast. It is 2022. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am here with Brandon Beaver. Brandon, how are you?
I'm good. My sister is actually pregnant. She's due today. And it's twins. So two of them on two.
Wow.
That's not true. I don't even have a sister.
Oh, well, you had me going.
It's Tuesday. It's Tuesday. The second day of the week, February 2nd.
It's the third day of the week.
February 22nd, I mean. The second month of 2022.
Yeah, it's the third day of the week, buddy.
No, it's not. Sunday was the last day. It's Tuesday.
Sunday's the first day of the week, man.
Well, of the work week. If your work schedules.
Yeah. Okay. All right. I'll give you that. Hey, did you know that COVID infections have plummeted 90%?
What's COVID?
Right? From the pandemic high.
That's still a thing.
90% drop.
Oh.
That's good news. Got to be good for the economy, right?
Well, yeah, for sure. We'll see what happens with oil.
Oh, you just said my 3-letter word there, buddy.
I want to buy Delta at 35 again.
Is it at 35 right now?
No, it's I think it was at 40 or something like that.
See, I was about to say, I'm like, if Delta's at 35 and COVID infections are down 90%, I'm going to be throwing some money that way, buddy.
Well, the next headwind's oil. I mean, the headwind currently right now is oil, but we still have about another $5 to $10 a barrel to go. So,
but they hedge. These airlines buy barrels of oil at an earlier price. So when's the next time they have to do up contracts? You know, when's the next time they hedge?
Maybe.
See?
I don't know.
They could be paying right now $60 a barrel price because they hedged 2 years ago.
Something for us to look into, maybe for the next episode.
Yep.
Another Dr. Dre reference after the Super Bowl.
I was just thinking of that song. All right. You ready to get into it, man? Or
no? Yeah.
I mean, you can tell me. I mean, I'm feeling a little worn out. I've been working out, trying to get in shape, guys. So hopefully these pictures on my Instagram, when I post them, I'll start looking thinner bit week by week. But I'm sore, I'm hurting, but I'm really pumped for the show. So let's rock and roll, buddy. Rules. Here's the rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We do not discuss it here. The live discussion here on the show. Brandon Beaver has the meat of the discussion tonight, so we're going to let him take the lead and run with it. Brandon, go right ahead, man.
All right. Every day on the news, we see administration officials talking about the Ukraine crisis. Secretary of State Anthony Blinken, or as he's often presented on CNN and CNBC as A. Blinken. Every time I see it, I think of Robin Hood Men in Tights. The Hey Blinken scene.
Yes, I am familiar with it. Yes.
Somebody say Abe Lincoln. Okay. All right. So he's almost a household name. Almost, because he's always talking about the Ukraine crisis that's going on right now. And the conflict is affecting commodity prices, sending them higher, especially Dave's 3-letter word, oil. Escalation in this conflict. Here's the fears, okay? Escalation in this conflict might further increase prices in an environment that has already had commodity prices soaring. The fear is that increasing commodity prices will cause businesses to decrease spending and put the brakes on an already slowing economy. Everybody's freaking out over this, right? The market's dropping, not just because the Federal Reserve is raising interest rates this year, but because of the Ukrainian panic. There's a lot of market anxieties, and I want to talk a little bit about how to calm your anxieties and invest in a way that you can sleep at night, because this shouldn't interrupt your sleep schedules. This should add to your life It shouldn't detract from it. You shouldn't be checking your phone every 5 minutes while you're supposed to be working, or while you're supposed to be spending time with your loved ones. If you're doing that, either A, you don't have enough experience yet, you need to study, you need to listen to us, you need to read books, you need to do all that good stuff, or B, you're taking on too much risk.
Yeah, this is not a sprint. This is a marathon, and you get there by having base hits all the time, not by home runs every week.
Right. So this is worrying about your investments and worrying that they will lose value, worrying that they might not raise back to break even prices for years, or even worse, that they will go to zero. If you're worried that your investments are going to go to zero, you're either taking on too much risk via maybe too many option plays, or maybe you're investing with margin, or you're inexperienced. So this is just things like, read books, get your knowledge up, and maybe know better what you're doing, or maybe de-risk a little bit, and you'll be able to calm down. You could ride these waves much easier if you're able to trade with conviction, and if you're not trading with money that you're going to need in the next year.
And I've always recommended to people, even if you've been trading for a year now or 6 months and you feel like you got it, you can always just take a break from actual trading and just paper trade for a week or two and kind of fill yourself out, or even a month or two, and make sure you still are on the right track.
So hold your positions through this, the positions that you have convictions with. I mean, unless you sold Apple today because Russia might invade Ukraine. If you did that, maybe liquidate your entire portfolio, take some time to read some more books. And when you have a better mindset and education, maybe come back after then, because it's just a crazy thing to do.
That's a little rough, but I get your point. It is a correct point. Yes.
Yeah. But so here's the thing. A lot of people just operate with emotion, and listening to this, you may think that like, if this is common sense, right? But once your emotion and your fear take charge, then it's different. Then you start freaking out and you want to sell because something's down. And that's not the right reason to sell something just because it's down. Oftentimes, if it's a great company, if it's down, you should be more bullish on it. It should make your conviction more firm to hold it.
Yep. 100% agree, man.
All right. So buying too high can be a problem too. This is another reason why people become anxious. They fear that they bought too high, and this can be a problem, sure. And if you can wait, you can be patient, you can buy on the dips. The lower you buy a stock, the better your returns are going to be. That's for sure, certain. But even if you buy too high, oftentimes buying too high in a good company that you have faith in, it can pay off in the long term. Just having some patience and some conviction, and maybe you do cost average down on those when you have a good reason to. But it's not always going to break you. So I wouldn't freak out about that either. And you should never sell an investment just because it's down. Like I said, the distinction here that I'm making right now is between a trade and an investment. They're two different things. And before you buy any stock, you should make sure that you have that distinction in mind. Okay, I'm buying so-and-so X stock XYZ because it's got a great technical setup. And if that technical setup fails, fine, take your losses, get out of it. You should, right? You shouldn't stick around for it, just hope that it'll go back up at that point. But if you're buying because of solid fundamentals, and those fundamentals are still in place, and it really doesn't matter what the price is right now, the price will catch up with the fundamentals, and it will catch up with the earnings. You just hold it, or maybe cost average down if you want to at that point.
Let me give a couple of real life examples of the difference here, and kind of what I think you're trying to point out is I got a long-term investment in NVIDIA right now, right?
Yeah.
I bought it and it's been flat for me since I bought it. It went up at first and I was like, woo, yeah. And then now it came back down, and I'm like barely profitable. And it's like, that's a long-term investment. I'm holding that one. I'm going to wait for my long-term investment on it. However, on Friday, I made a trade. I bought some oil stocks, and it was because of these tensions. And I was concerned that the price of oil would go up, and that the oil companies in turn would go up as well. And I fully intended when I bought them just to be a swing trade, something I don't hold that long, but I make money off the emotions and the macroeconomics of the market. So on those, if on the trade, if it dips, below my stop loss point, then it's going to sell. But my investment, I don't have a stop loss because that's long term and I believe in the company.
Yeah, exactly. And you mentioned oil, I think, on the 10-minute break with Dave that you did.
Yes, I did. And that's when I let people know which ones I bought.
Okay.
I bought XOM and RIG.
So I'm going to be doing a 10-minute show this week at some point as well. And I'm going to be referencing and probably going over Howard Marks' recent memo called Selling Out. Howard Marks, he's the co-founder of Oak Tree Investments. He's been writing memos to investors for the past 40 years. And you should really read them. They're full of great insight. And I'm going to be referencing them on Friday and reading a little bit from it and talking about it, giving my insights on it. And but for tonight's show, I'll just say this. He says that there are two major reasons why people sell an investment, and it's either because it's up or because it's down. And he says both are wrong. It should, in any investment, it should be driven by fundamentals or value. So if you're selling a stock because it's up, it should be because, say, for example, the average price to earnings ratio over the past 10 years has been like 20, and now it's got a price to earnings ratio of 40. So you're selling it when it's overvalued. If you sell it because it's down, it's because the fundamentals that you first bought into the company for are now deteriorating. That's when you want to sell, right? Too many people panic sell because the stock has dropped. This involves selling out completely or trimming a portion because you expect a drop. Many retail and professional investors trade around what they originally considered long-term positions because their emotions are driving them to do so. This usually creates bad results because you're mixing your trades with what we're supposed to be in investments, and you're letting your emotions drive what you do, and you shouldn't be doing that. You should be operating completely on a rational basis. If you expect that there's going to be a temporary drop, maybe a cost average down, just take that opportunity to add some more into it. But I wouldn't sell it at that point. If you're looking at a company that you're thinking that you're going to hold for the next 10 years, who cares about a 1 week or 2 week drop, or even really a 3 to 6 month drop? It's not going to matter in the long term. If you expect it to keep going up, you just hold it and you will do better in the long run for sure. Okay. I'm telling you this from experience. There is trades that I made that I expected to be investments that I should have just held. Apple, I have made money on every single trade I've made on Apple. But if I would have just held it the first time I bought it and still had it now, I'd be a lot better off than what I was. I missed a lot of upside on that because I turned what should have been an investment into a trade. It's personal experience here that I'm telling you from. So before you buy a stock, make distinctions. Is this a trade or is it an investment? Are you buying because of fundamentals or because of technical indicators? Sometimes it's both. And that would be a situation where you're attempting to set yourself up with a long-term investment at a good price for the short term as well. And that's fine. But it's often a mistake, like I said, to trade around these long-term positions. So any thoughts on that?
No, I love that point, and I love that quote. And I really like your real life example there of Apple, because you made these 5% gains each time. But if you would have just held Apple at, whatever point and held it for the long term, you would have made a lot more than what those 5% gains gave you.
Yeah.
Now you did admit that you bought them just for a trade. You never had the intention of an investment at that time. But if you knew what you knew then, looking at it and looking at the fundamentals, would you have bought it knowing what you know now and held it for an investment?
Yes, I bought it at $93 back in 2013, pre multiple splits that it's had since then, I think. So, I mean, I'd be up a good, I would say 100%, if not more, probably more. Actually,
Gotcha.
probably way more, because I think I bought it when it was trading around a $500 billion market cap, and now we're over trillion. So I'd be up like 300%. So yeah, I would have done a lot better on it. But conviction is it is important. I talked about that. The conviction is very important as long as it's guided by knowledge, but don't let conviction poison you. If you're in a trade based on technical indicators and those technicals fail, you need to move on. That's the time to take your losses. If you're in an investment because of fundamentals, but those fundamentals are no longer valid, they're no longer holding up, and you rationally judge that it's time to move on, then it's okay to move on. Do not invest money that you're going to need. This is another thing that will keep you up at night. If you need to buy a car, or if you're in the process of buying a house, or say you're in a job and the job's not doing so well and you may lose your job, I would not take money out and invest the money that you're going to need, or even really trade with it, because then what we're talking about now is going to increase the chances that you're going to act irrationally and have emotion involved. And those are things that we are trying to get away from. And because, look, it's not just retail investors that do this. Professional investors do it all the time.
Yeah, and I like your word uses, because I've always said, just not emotional. You got to be self-disciplined. You got to be. I guess you do. You have to pull the emotions out of it and just look at it as this is your retirement, like a 401k. It's not there that you need it to pay for gas that week or food for that month. Now, once you get to a certain level and it's producing the income on a consistent basis over an extended period of time, then maybe you could start using it as a 401k is used in retirement and live off of it.
Yeah.
But you need a substantial amount to get to that level, and it takes time. But right at most beginners, when they start investing, they don't have that amount in there. And to your point, they put money in there thinking they're going to quickly double it, and then they can go ahead and start and take out. So they put in $1,000 and they think in a month they're going to have another $1,000, and they can continually just keep pulling out $1,000 a month or something. And that's the wrong mentality to have.
Yep. Trying to hit that home run, trying to get rich overnight.
Yeah. It doesn't happen. Well, it does happen. It does happen, but the chances are very, very slim and rare.
So another reason why you may be losing sleep at night, checking your phone, when you're supposed to be doing other things, is that you're in margin. And I'm not gonna sit here and say that margin can be a good tool, right? But it needs to be used scarcely and when there's sufficient reason. I would say the COVID crash would have been a good time to use margin if you had to.
I hardly ever use margin, except when the only times I have to use margin is when I'm short in a stock, when I do a short sell, because there's no other way to do it without using margin. Other than that, I have refrained from it. Even when I was poor and broke and working 3 jobs. I don't know if you remember those times, Brandon, when you knew me, and I was dead tired and I hadn't slept in 3-4 days, and I'm eating, just store brand cornflakes and bar S bologna and, all that fun stuff at that time in my life. I had my stock accounts and I was trying to grow them so that I could, move on with my life. And I eventually did, but you can't be irrational with it, man. You got to take the emotion out of it. It's your retirement account. Don't touch it. I forgot where I was going with that point, but the point's still valid.
Dave has forgot more about the market than you know. So
oh goodness me. Yeah, I've traded. Yeah, that's a good quote. I like that.
You know what?
I'm gonna put that on a t-shirt and put it and hand it out.
This is a great time in the market right now, just to go back to the basics. Anytime you have this kind of volatility, and I think the rest of the year is going to be tough with the Federal Reserve raising interest rates up to possibly 7 times this year. And now you got the Ukraine situation. There's fear of a Taiwan situation with China. I do think the rest of this year is going to be rough. I fail to see how the Ukraine situation might take down Microsoft's earnings or Apple's earnings. And yet Microsoft's down 3 months for the past 3 months. I mean, this has to be interest rates as well that's affecting this. But for the past 3 months, Microsoft is down a little over 14%. I think it's okay to start buying this company right now. I do not expect tech to just take off in the next like couple of weeks or even 3 months. I don't expect it. That doesn't mean it won't happen, but I don't expect it. So I think when you're buying these good companies that are getting beaten down, you just hold them. Even, even with Meta, like I'm down like almost 10% right now, but this is like a 10-year thing for me. So I'm fine with it. You just have to kind of like maybe meditate or maybe find religion or something that might help you out. But the calmer you can be while you invest, the better. And maybe go back and read some Warren Buffett books or books on Warren Buffett. Unfortunately, he hasn't actually authored a book yet, which is disappointing. I really hope one day he will. Howard Marks is good, like I mentioned, from Oak Tree Investments. Podcasts like us, just something to keep you level-headed. You need to invest and trade with a level head, otherwise you're not going to do so well.
Hey, I listen to podcasts when I'm driving down the road as well. So I mean, I do things to try to keep my mind at ease and constant state of growing, and it works for me. And then I forget it once I get where I need to go, right? So
maybe take a week off for CNBC and then because what the news does, they're of course they're about ratings, right? So they're going to drive fear when there's fear, and they're going to drive greed when there's greed, because those kind of things, they get people to watch. So if you turn on CNBC tomorrow and the sky's raining, fire and blood and all that stuff, don't be surprised by it, but don't let it panic you either. I mentioned Microsoft. I mean, the gross profit margin here, 73.97%. This is increased over the past quarter, despite inflationary concerns. This is another one of those companies that I thought would do decently well in an inflationary environment. I'm still concerned about the 7.5% inflation number that we just had. I mentioned that at over 7%, stocks don't do very well in those kind of environments, and we're past that now, and a lot of people are guessing that the next number may come in at 8% or higher. So
it just keeps going up.
I am concerned about that, even for companies like Microsoft and Apple, but I do consider anytime they get beat up, you buy them, because they're just great companies that are run very well. The net profit margin for Microsoft Corporation's 36.27%, which is it's phenomenal. It's above the average for their industry. I really like Microsoft, and I'm still saying to buy. Now, I was looking at Sony as well, and Sony it's almost into value territory right now, but I'm a little concerned. The fact of the matter is that a lot of people in the market's kind of expecting right now, the consensus is that the earnings per share for the year are going to be down around 18%. I really need to investigate that and see why that is. And I'm wondering if it's the chip shortage. Go ahead, Dave.
Yeah, I mean, I get Microsoft. Do you think part of it being down has to do with the Activision deal?
Yes. And so here's the good part about that, though. So the Activision deal is likely priced in, right? So that shouldn't have much of an effect on the stock anymore. Now, the SEC is investigating this, and so's the whatever department of the government that investigates these things, not just the SEC, but I think the Justice Department even looks into them, which is weird. But if the government rejects the Activision deal, I expect the stock to actually react positively to that.
Okay. Yeah, so, I mean, I would too.
I think
now they're not spending the money on buying it. So
yeah. So I think with the Activision deal, it's kind of a win-win situation, right? Because I do think they bought it at a decent price, fair value. I don't think they got it undervalued, but they bought it at a fair value because it's been beaten down by all the sexual harassment, lawsuits and situations that have happened within the company. So they were able to get it at a decent price. And I do think that they could probably do some good things with it and use Activision, the Call of Duty franchise, to really compete with Sony on an even bigger scale.
Yeah, but then Sony went out and bought Bungie, and so now they have Destiny and Halo.
Yeah, that's crazy. But doesn't Microsoft Studios still have something to do with Halo as well? I think they're intertwined.
Yeah, so they are intertwined. Yeah, it's like the fact that Marvel got bought out by Disney back in the day, but Sony still had the rights to certain Marvel movies, so Sony could play them. I think it was the early Spider-Man, so Tobey Maguire and the other one. And so there's always these intertwined in there, but Sony, if you're saying it's down, it's a media company, it's also a hardware company, it's a gaming company. There's so much that there's so much that Sony's into. It's hard to see where the drop is without me actually going into the report there and reading it and seeing which department actually is falling short here. If I had to guess just off the top of my head, based off looking into Sony in the past, I would say this is more of like a chip shortage. They have a lack of a product available to go out, and I would say that has a lot to do with it, because the media portion of the company should still be able to put out movies and TV shows and so on and so forth.
Yeah, if it's the chip shortage, I may buy this because there's still such a demand for that PlayStation 5. Once the chip shortage does clear up, it's going to take off in sales even more. I believe right now, even with the chip shortage, it's the best selling console in United States history. And if any listeners are listening to this, you want to go Google it, find that, because I'm not 100% for certain on that.
I'm going to Google it right now. Here, buddy. Here we go.
I'm about 85% on it. While you're Googling that, I'll get into the next subject here. I noticed that FedEx has given back most of its gains that it got from the stay-at-home environment, the COVID situation. And a lot of that is the price of oil is spiking. Now, the gross profit margin here is 69.81%, which is great, but the net profit margin is only 5.18%, which is terrible. And they are suffering for it. As a result, for the year, FedEx is down 14%. Now, on the other side of this, their competition, UPS, has a gross profit margin of 76.46%, but a net profit margin of 13.25%. If you go back a few months ago to one of the podcasts that we had here, I talked about the importance of the net profit margin going into an inflationary environment, and it is very important. And the result is that UPS is up 34.84% for the year. And as I said, FedEx down 14%. So two totally different charts of companies that are competitors in the exact same industry. Now, at the same time, the USPS, the U.S. Postal Service, just announced that they're expanding. I think it's going to go nationwide, their next day delivery service. So that adds more competition to the mix here. And that could be another reason why FedEx is struggling.
I mean, that could be another reason. Amazon could be another reason. All these companies now doing their own shipping, having their own distribution networks, and cutting out USPS, FedEx, UPS. But I mean, a lot of companies still use UPS and FedEx for the small ones, because it's more cost efficient to ship those small packages with UPS, FedEx, and USPS. But
yep.
And I think UPS, because of their environment, they have set prices versus FedEx, and their third-party contractor setup, I believe, is they always have to renegotiate with new contractors all the time. And in order to keep it during the current environment, people are asking for more and more money. And so that's kind of what I think is happening there with FedEx.
Yeah.
Versus UPS doesn't have to, they only renegotiate every so many years.
So a lot of headwinds here regarding FedEx. I think their price to earnings ratio is around 12. So they're entering value territory. I'm not calling it a buy right now, but I'm not saying that you shouldn't buy it either. I'm kind of on the fence with this one because it is at such a good value, but it is at a good value for a reason. It's not like it's an irrational drop completely. Now, FedEx also announced a partnership with Microsoft, and they're going to be using some of Microsoft's tools to reinvent sort of the logistics process, and using their customer relationship software. This is another reason why I like Microsoft, and I think that Microsoft is going to be a driving force for the future of retail, because they are in the supply chain situation. They're in data analytics and all of that. So Another bull case from Microsoft. I wouldn't call FedEx a buy. UPS is it's a little high for me right now, and the
What's the
oil
PE on UPS?
situation. Let's see here. It's not bad, really. It's I was just looking at it. It is at 14.26, so it's not terrible.
That's yeah.
Even for the run that it's had in the past year, it's what, I'm iffy on that too. I'm on the fence here just because of the oil situation. If you get dips on UPS here, if we get that $5 to $10 a barrel rise, any of those oil price increases are going to be temporary. I think we're heading towards an electric future. I think at that point you get a nice dip on UPS, you buy it.
Hold on. I agree with temporary, but I think our definitions of temporary in regards to oil are different. How long are you defining it? Because you made the comment just now, 2 seconds ago, that the rise in oil is temporary because we're moving to electric. So to me,
Yes.
that tells me that you're thinking years, not months.
Yeah, temporary over years. And you may even have the short-term price increase because of the Ukraine situation, and short-term price increases because of travel and increased demand for experiences that consumers are going to have this year. With the COVID cases being down 90%, a lot of people are going to want to travel either by plane or by car, and that's all going to drive oil prices up, right? But here's the catch-22 to it. The more oil prices go up, the faster we're going to get to an electric future. Because the more demand there will be for Tesla, Rivian, and Ford electric vehicles, and Chevy electric vehicles, GM, whatever.
Yeah, I hear you. I hear you.
And oil's not going away.
I'm positioned for that. I have a long-term investment in a company called Cooler Technology, so I'm okay with an electric future. However, they don't have a electric car that could drive cross country yet. You got to stop and let it charge for 6 hours, so that's going to slow down your drive right there. Yeah, they don't have electric planes. The one that they did have kept having smoke and everything in there because they were not using Cooler Technology systems. There's a lot of things that we're not quite there yet, but yes, we are on our way there. I'll grant you that. I've talked many times about Elon Musk and his AI electric trucks that are moving, and that system will be up and running in about 5 years. That should be up and running to more routes than just the Phoenix to LA, so.
I think that, if we get above $100 a barrel, you're going to see dips on good companies that you can take advantage of. And this may be the last year that we have $100 oil. It may not happen again.
Really?
Mm-hmm.
I don't see. I don't know if I agree or disagree. There's just too many things I would go into here and like delve into a black hole here of like all the possibilities that could happen with oil and with the world economies and the global economies. The United States could, within just 2-3 months, we could drop the price of oil down by like $30-$40 a barrel if we just let loose on US drilling and allow the US companies to drill oil and pump it out for our own ground. We could drop it down to $60 a barrel very quickly, very easily. So there are ways to control the cost of oil. It's just up to different political environments of whether or not those are friendly and available to do. I mentioned before in the past as to what happened with oil back in 2020 when the current administration got voted in, and what they cut all the permits and said we canceled them all. And that's why we saw the rig count drop drastically. That's why we saw so many things happen drastically. And there was a lot to do with that, and that they still haven't recovered from that, and they haven't started in those drilling as well. There's issues now with the pipeline that has been sanctioned because of the Russia event of oil going into Europe. So there's low supply around the world, and that's what's driving the cost up. Demand hasn't gone up. demand is actually about the same, but there's low supply. But we have the ability to very quickly raise the supply at any given time and drop it. So yes, but if we move to more electric, the government will say, hey, or I don't know who will, but most administrations would say, why would we start pumping out more oil when we have all these electric now? We don't need it. And so it could keep it high on purpose just to go ahead and move forward with that electric movement.
Yeah. For now, they have to walk a fine line in between making a profit and keeping consumers apathetic. Because
right?
if oil is at least semi-cheap, then you're not going to be motivated to make a change in the way that you're driving and go out and buy an electric car.
And it only hurts the poor. And I've said this again, they're the ones who don't have the electric vehicles. They're the ones who live in apartment complexes and they don't have charging stations set up. They're the ones that are, going to be hurt because they drive gas cars. It's the upper middle class and the rich class that are able to have these electric cars. They're able to drive them around all the time and they're able to afford them and have the charging stations. And it's when you raise the cost of oil, you actually hurt the poor. And I don't, I'm not a fan of that.
Me neither. They are getting cheaper, which is good.
They are getting cheaper. And we talked about that last time, how the only cheap car was made by Tesla and it wasn't even that cheap. And I talked about the Pear, that one coming out, and how it was going to be priced at starting at $29.90, which is the lowest cost electric car in the United States. And that's still, you could go out there and you could buy, other newer cars a little less than that. So I mean, it's still not the cheapest car, but it's the lowest. It's gonna be a low cost electric car out there. So they are starting to provide options. It's slow moving into that market because the technology is still newish and it costs money to develop this technology and put it into working vehicles. You can't just take a new technology, put it in a vehicle and, charge $10,000 when it costs you $100,000 to create it. Right. You got to pay for that somehow.
Yep. There's going to be a situation in the future where these cars start to be, I mean, they're already on the used market, but eventually you'll be able to buy them for $5,000 used.
Eventually, once you get to that point, then we've saturated the market enough. We've moved through with the gas cars. We moved them out of the market, and now we've come to a place where that could be true for the U.S. consumers. Now, what kind of places actually produce most of the smog? Is it just people driving to and from work? Or is it business travel? Is it trucking? Is it shipping? Is it, what are we looking at here? Is it airplanes? We can't do it right now, an electric airplane. It doesn't produce enough propulsion to fly the airplane.
Not yet. I think General Electric is working on it with some partners, but yeah, no, at this point in time, no, maybe in 5 to 10 years from now, we will have electric airplanes, but
I mean, you see my point here. I mean, there's so many other areas. I mean, yes, let's continue going in this area and have some investments. Blink Charging, I've always said, is a great company to invest in if you believe this is the future. Put your money in Blink. They're the one getting all the government contracts right now. You're going to see their charging stations up everywhere around the country. That's an investment if you believe in the electric cars and electric in the electric movement in the United States. Blink Charging is an investment to have.
Gotcha. Well, that's all I have for today. You got the floor from here on out.
All right. I don't have much more because we kind of mixed in what I wanted to talk about with what you did, but I'll just rehash it one more time. I'll do like an elongated closing comment section for me, and then I'll give you the last few minutes, if you will, to talk about it. So I want to talk about like some of my plays right now. Everybody knows I'm into NVIDIA, I'm into Intel, and I'm into Cooler, right? Mm-hmm. Well, NVIDIA and Intel for me are flat since I bought them. They are not really moving for me. NVIDIA had jumped up for me quite a bit, and I was very happy with that. It went up to 270 at one point, and I was like, woo, yeah. However, right now they've flattened. Nvidia's given back all those gains it had. They're back down around 233, 232, somewhere around there. And they're staying flat, right? So I'm not concerned. Just like you were saying, Brandon, this is something I was going to bring up as well, was I'm not worried about it. These are my long-term investments. I'm not going to sit there and watch those day in, day out. I'm not even really, the only reason I would even look at them is because that watch list came up first before I switched to my day trading watch list. And that would be one of the only reasons I saw it. Now my trades such as ExxonMobil and Rig, turns out, I'm up on Nvidia and Intel, my long-term ones, but my day trades, I'm currently down about 1% on both. Could go figure. But, I firmly believe that, oil, like you said, and many times in this conversation today, that it's going to have some short-term rise due to escalated and tensions around the world and sanctions now being put in place. And I agree. And I believe with the higher price of oil, ExxonMobil and Rig are going to make more money, and because they could charge more money. And I made a play on it. Whether or not I turn out to be right or wrong, we'll see. Definitely going to be watching them tomorrow, because if I have another 1% drop in them, since it is a day trade, I don't want to take too big of a percentage drop in them. If it was an investment, I wouldn't even care, but it's a day trade, and I want to cut my losses if it drops again. But that's the ones I'm looking at. Like I said, if you believe in the electric movement, Cooler, it's a great company to own long term. They still have a price target of $3.50 and $4 from different investment companies, giving them a price target of that price. The only reason they dropped, and I believe this to be the case, is the CEO sold a lot of shares at the end of the year last year. He still owns a lot of shares. I want to preface with that, but he sold close to 1 million shares, and rightfully so. I mean, you start the company, you get it up and running, you kind of want to eventually take some profit and spend it and get a house for yourself and so on and so forth. I don't blame the guy. He still has over 21 million shares of the company, so that was just a fraction of his total account holding there. But the company has all these new contracts coming out, right? They were moving up with just very little profit. Now with these new contracts, they should have immense more profit. Their profit should grow by over 1,000%, is what many people are estimating, including myself, that the profit on this is going to be spectacular, and the profit margin is outrageous. Wow. Their profit margin is 74% on all their products. Okay. 74%.
So that's above my mark of 40.
Yeah, that's above your mark of 40. And they have a debt to assets ratio of just 14%. Okay. So their total debt's just 14% of their total assets. Oh. So I mean, this company is a great, strong company. I believe in it for the long term. I'm holding it for the long term. This is not a trade for me. And I know if you're looking for, something to do with, like Brandon said, electric, we're moving in that way. We're moving away from oil, then, Cooler's a good one to play. Blink's a good one to play. Look for new, innovative companies that are new. You don't know a lot about, but they're doing really cool things, and they're getting the contracts now, because you're going to hear about them in a year from now. And then you're going to be like, I wish I knew that company then.
You mentioned the debt to asset ratio. That's very important for people who are looking for safe investments. And that's not a commentary on what the volatility of the stock might be over the next, short term, the 3 to 6 months or whatever. But the debt to assets ratio, that ratio is very important, because that tells you that if for some reason this company was to fail, then they would have enough money to pay back investors. Oftentimes, if somebody goes bankrupt, if a company fails, the stockholders are just left holding the bags. The bondholders get paid first, and then after what you get whatever's left, if anything. So it's the bondholders, the debt holders, and all of those people. They get paid first if a company goes bankrupt. Stockholders get whatever's left, and oftentimes it's zero. So when you have that debt to asset ratio, and it's that low, that's a great indicator, first of all, that things are going well for the company, and that they're investing in ways that they need to be investing, and that they're not overspending. But second of all, if things do go awry, that it's relatively safe for you.
Right. Exactly. But I mean, those are just some things and some ideas I wanted to float out there, put in people's heads and think. I loved all your points today. You had a very good talk. Brandon, go ahead. Last comment's yours, man.
Okay, so I was talking about that whole buy low, sell high thing, and how it's, you know, things are a lot more nuanced than just that. Howard Marks also brought up in this memo that Will Rogers, he was an American film star and a humorist of the 1920s and 30s, once expanded upon this, and he kind of showed the ridiculousness that this can create. And he said, "Don't gamble. Take all of your savings, buy some good stock, and hold it till it goes up. Then sell it. If it doesn't go up, don't buy it." You get that?
Oh my goodness, that's funny.
So don't freak out if you bought too high. Sometimes if it's a great company, just time is your friend. The good thing about buying a stock rather than buying an option is that you have the most valuable weapon on your side, and it's time.
Yep. Amen. All right, guys. As always, we hope we've been entertaining, educational, and uplifting, because we want everyone to make money. You guys have a good night.
Have a good night.
Hey, Blake, did you say Abe Lincoln? No, I say Abe Lincoln. I said, hey, Blinken.